We're going to review an interest-only mortgage. The most important thing to understand about an interest-only mortgage is that you pay only interest and no principal during the initial interest-only period of the loan. This means that your mortgage balance does not go down during the interest-only period. Following the interest-only period, the interest rate and monthly mortgage payment can change on a predetermined basis, which is typically every year, plus the loan starts to amortize, which means the borrower is required to pay both interest and principal for the remainder of the mortgage term. This is also known as the adjustable rate period and is why interest-only mortgages are also called interest-only adjustable rate mortgages or interest-only ARMs. The term or length for most interest-only mortgages is 30 years, and the interest-only period, when the borrower pays interest only and no principal at a fixed interest rate, is usually the first 3, 5, 7, or 10 years of the mortgage. The interest rate and mortgage payment during the interest-only period is typically less than the interest rate and payment for a loan, such as a fixed-rate mortgage or an adjustable rate mortgage, when the borrower pays both interest and principal. This is one of the reasons people select interest-only mortgages. During the adjustable rate period, which follows the interest-only period and lasts for the remainder of the mortgage term, the borrower is required to pay both principal and interest, and the interest rate and monthly mortgage payment are subject to change. Because the borrower has to pay both principal and interest, and the interest rate may also increase, the borrower usually has to pay a higher monthly mortgage payment after the initial interest-only period for the remainder of the mortgage term, and in some cases, a significantly higher payment. These mortgages are called 3-1, 5-1, 7-1, and 10-1 interest-only ARMs, or IO ARMs. So in the case of a 7-1 interest-only ARM, the borrower pays only interest at a fixed interest rate for the first 7 years of the mortgage and then pays both interest and principal at an interest rate that is subject to adjust annually for the remaining 23 years of the mortgage. The interest rate for the adjustable rate period is called the fully indexed rate and is calculated by adding the margin, which is fixed over the life of the loan, to the index, which is an underlying interest rate that can change over the life of the loan. The fully indexed rate is recalculated on a predetermined basis, which is typically once a year, for the remainder of the mortgage term and will change with any fluctuations in the index. So, in the case of a 7-1 interest-only ARM, the fully indexed rate adjusts on an annual basis for the final 23 years of the mortgage. This means that the interest rate and your monthly mortgage payment can change and potentially go up every year over the last 23 years of the mortgage. There are a lot of pieces to an interest-only mortgage, so I'm going to use an example to demonstrate what the terminology means and how everything works. I'm going to use a $300,000 mortgage for this example. First, let's start with mortgage term, which is the length of the mortgage in years, and most interest-only mortgages have 30-year terms. Next, we have the interest-only period, which is the initial period of time during which the borrower pays only interest and no principal, and our interest rate and monthly mortgage payment do not change. I'm going to use 7 years in this example. Next, we have our interest-only period interest rate, which is our interest rate for the initial interest-only period of our mortgage. Let's use 3.375% in this case, which means our monthly mortgage payment for the first 7 years of our mortgage is $844. Remember, the interest rate and monthly mortgage payment in the interest-only period is typically lower than the interest rate and mortgage payment for a 30-year fixed-rate mortgage. But it's important to point out that we do not reduce our mortgage balance during the interest-only period like we would with a fixed-rate mortgage. So our mortgage balance at the end of our interest-only period, or the end of year 7 in this example, is the same as our initial mortgage balance, so $300,000. Now we can focus on the adjustable rate period, which is the remaining 23 years of our mortgage when we have to pay both interest and principal, and our interest rate and mortgage payment can change. First, I'm going to define our adjustment interval, which will determine how frequently our interest rate can change during the adjustable rate period. The adjustment interval for most interest-only mortgages is a year, so that's what I'm going to use in this example. Next, I'm going to define the fully indexed interest rate, which is the interest rate for the adjustable rate period of the mortgage. The fully indexed interest rate is calculated by adding the margin to the index. The margin is a set interest rate amount that does not change. The margin is typically 2 to 3%. I'm going to use 2% in this example. The index is an underlying interest rate that can change. Lenders typically use the 1-year LIBOR or 1-year Treasury note as the index. These are interest rates that change with fluctuations in the economy. Let's use the 1-year LIBOR as our index in this example. So let's say that at the end of our fixed rate period, the 1-year LIBOR is 1% and our margin is 2%, so our fully indexed rate is 3%. So in year 8, the first year of our adjustable rate period, our interest rate is 3% and our monthly mortgage payment increases to $1,506. It's important to point out that our mortgage payment increased significantly as compared to our payment during the interest-only period, even though our interest rate decreased from 3.375% to 3%. This is because the borrower is required to pay both interest and principal during the adjustable rate period, so our monthly mortgage payment increases significantly. The fully indexed rate is recalculated on an annual basis basis for the remainder of the mortgage term and will change with any fluctuations in the index. Interest-only mortgages typically do have limits, also called caps, on the amount by which the interest rate can increase. There is an initial adjustment cap, which limits the change in interest rate for the initial adjustment period following the interest-only period. So in this case, year 8 of our mortgage. The initial adjustment cap is typically 2% or 5%, and I'm going to use 5% in this example. Interest-only mortgages also have a subsequent adjustment cap, which limits the change in fully indexed interest rate in any adjustment period following the initial adjustment period. So years 9 through 30 in this example. Subsequent adjustment caps typically range from 2% to 5%, and I'm going to use 2% in this example. Finally, interest-only mortgages have a life cap, which limits the increase in interest rate over the term of the mortgage. So if our life cap is 5%, in this example, it means that the maximum interest rate for our mortgage over the life of the loan is 8.375%, which is a significant increase compared to our interest-only period interest rate of 3.375%. Because it is impossible to predict what interest rates will be in the future, it's impossible to know what your mortgage payment will be during the adjustable rate period of an interest-only mortgage. But to highlight the risks of an interest-only mortgage, I'm going to show you the worst-case scenario, when the interest rate increases as much as possible, as quickly as possible. So let's apply our maximum interest rate of 8.375% to year 8, the first year of our adjustable rate period. Our mortgage payment jumps to $2,454, which is a significant increase as compared to our interest-only period payment of $844. Granted, this worst-case scenario is unlikely, but it gives you a sense of the risks associated with an interest-only mortgage. Given the complexity and risks of an interest-only mortgage, you may be wondering why people select them. People typically select interest-only mortgages because the interest rate and monthly mortgage payment during the initial interest-only period is typically lower than the interest rate and payment for a fixed-rate mortgage. This also means that you can typically qualify for a larger mortgage with an interest-only mortgage than you can with a mortgage that requires you to pay both interest and principal for the entire mortgage term, such as a fixed-rate mortgage. So if you know that you're only going to own the property during the interest-only period, then an interest-only mortgage may be the right program for you. That way, you can qualify for a larger mortgage amount and also benefit from a lower monthly mortgage payment during the interest-only period, but you are not exposed to a potential increase in interest rate and monthly mortgage payment during the adjustable rate period. The other reason to select an interest-only mortgage is if you think interest rates are going to decline significantly in the future. Although predicting interest rates can be very challenging, so this strategy exposes the borrower to significant risks. We encourage you to review related freeandclear.com videos such as What Mortgage Program is Right for Me, and check out our detailed discussion of interest-only mortgages in our mortgage program section, as well as our interest-only mortgage calculator on freeandclear.com. Thank you for reviewing how interest-only mortgages work with freeandclear.com. freeandclear.com.